indicators. Now, we will bring up some bullish examples. So just kind of know we're going to have more of a balanced discussion on that. However, there are some things that we need to actually bring up. And just want to make sure we kind of show examples of bearish and bullish. Now, the other thing I want to kind of go through just real quick. Okay. Okay. Just wanted to show that there was a little delay there, but we got to figure it out. So we're going to kind of show a balanced discussion on bearish and bullish indicators. Now, the reason why we bring up the bearish is there are some examples of some stocks that still really look like they may be at risk of even falling further. It's also going to be piggybacking on the discussion that we talked about from last week. Now, sometimes the market is just down, okay? And so sometimes as a trader, like a sailor, the responsibility is to identify which way the wind is blowing and maybe try to set the sail to catch that wind, okay? And sometimes that wind doesn't go to the direction you like, but you're actually realizing what is the dominant direction, okay? Now, first off, there are a couple charts that I think we need to really bring up that are quite key. Now, the things that we've been watching, okay, is crude oil. So 4 charts, okay? These 4 charts we talked about for, what, 3 weeks now, maybe 4? These charts are going to probably tell us about the sentiment of the market. I think we've beat it to probably near paper death, okay? Crude oil, we don't need to go there. We know the situation, okay? Oil prices, if we actually looked at crude oil as a proxy, well, if we close here, that would actually be the highest closing price we've seen on crude oil, light sweet. That's not Brent oil, but actually light sweet crude oil. I don't want to say that's a moving average crossover, but it looks like a moving average crossover. Now, if you filled up the gas tank on Friday, you know that it got ugly. Now, if you take also a look at the VIX, okay, second chart, okay, if that volatility is grinding to the upside, which it has been, yet the range in the market, the volatility, higher, right? Bigger waves in the ocean. Now, if you're trying to swim, bigger waves, so to say, on the ocean crashing down into the beach, it's harder to swim, harder to kayak, whatever you're doing, doing surfing, whatever, okay? So here we are sitting at 30. I'm not going to say that's an ascending triangle, but it kind of does look like an ascending triangle. So maybe could that volatility even go higher, okay? Now, it's very unusual, though, to get the volatility this high for this long. But given the situation that we've been in the last, let's say, 4 weeks or so, understandable, still remarkable, though. So the second chart, VIX. Third chart, the U.S. dollar. Now, we know that there's different asset classes, right? There's stocks, there's fixed income, there's alternative, there's cash products, things like that. The U.S. dollar, if I said, what does this kind of look like? Now, I'm not going to say it's an inverse head and shoulders, but it kind of looks somewhat like an inverse head and shoulders. It's not perfectly symmetrical, but you're kind of seeing on this right-hand side, maybe like a shoulder at 99 with a little neckline, okay, maybe at 100. If you look at the U.S. dollar compared to some of these other currencies out there, man, those other currencies don't look that great. So many of them. And so you're seeing some more investors as markets go down. Some investors might be saying or thinking, I want a little bit higher allocation to cash. Okay. So that demand for that US dollar holding. And the last one we're actually going to look at the fourth chart, just kind of take a look. Luckily, the rate dropped somewhat actually here today, and you're going to see it's 4.3, but last week we almost touched 4.5%. Those 4 charts, if these 4 charts are actually going up, you got equity pressure. We've been consistent on that. I would actually say they're still elevated on all of them. Okay, so oil, if we close here, highest close we've actually seen. VIX, hovering near 30. US dollar, pretty much touching a brand new breakout level. And the TNX, which is the 10-year maturity, you actually literally on Friday was actually sitting here at 4.5 with the interest rates on the mortgages over 7%. That puts a lot of strain on equities. The equities are companies, and the companies actually benefit on actually consumers or institutions buying stuff, okay? And it can curb that consumption, which then curbs the fundamentals, and then can curb the technicals of the charts, okay? So that's why we bring this up. Now, something I want to kind of bring up that I thought was noteworthy, if we take a look at the SPX, now this chart that you're seeing, we're just looking at this chart, and we're looking at the whole moving averages. Man, they have been pasty red, okay? Last week on what? Thursday, pressure to the downside again, retested near the prior low. Friday, opens up lower and says, I'm not done with that sell-off yet, and then pushes down even more. Now, if you take a look at this, one of the things that when we talk about, let's say, bearish in general, that's so tough is when you have gone up, okay, you get 3 up days, you get 3, well, excuse me, I'll say 4 green candles. Let me mark 4, okay? You get 1 up candle labeled shown in green, 1 green candle, okay, there, 1 green candle there, and you get 2 there. But the moral of the story is when if we said green candles were the bulls, red candles bears, you're going to see that when the bulls are winning, signified by green candles, they didn't win very long before the bears came back in and pushed them lower. Now, James, is there a canary in the coal mine here? I mean, I'm asking for a friend. Are we at the bottom yet? Something I want to kind of show just real quick. When we actually go back to this chart and we look at the horizontal support levels, what we've really done is we've really bent down into, like, let's say last summer, okay? Now, I don't think this chart is going to completely tell everything per se. I think from a sentiment point of view, there is value in bringing up. Now, if you type in $SPX A50R, now 50 is for the 50-day moving average. If you type in A100R, that would be for the 100-day moving average. A200R for the 200-day moving average. But let's just look at the 50-day moving average. Now, when you look at this, and I'm showing you, and I'll zoom in a little bit so we can see it as good as possible. This is where we were last April when we actually had, you guys remember, and gals, remember when we kind of talked about what was the taxation, right, on imported items, etc., right? And if you look at this, this is where we saw the percentage of stocks trading above, okay, above their 50-day simple moving average. What percent? It was 4%, okay? So we're talking about super bearish, okay? I mean, 4% of what stocks? The S&P 500 stocks. Now, where are we now? Well, we're not down there yet, okay? But here we are at 21%. Mother, uncle, for crying out loud. Someone throw the towel, okay? Now, if we back this up and said, how often is that we get something like that? Now, remember, this is like sentiment, okay? Now, if we take a look at this and we went back on a 3-year chart, and I'll show the 200 in just a second, how often do you kind of get down to this point? Well, I mean, let's just kind of use the 20%. So over to the right, I'm marking 20%. The answer is not very often, okay? Now, did we go lower than that? Yeah, we did. That was the taxation last spring. You also saw it got like that in 23 as well. That was at 10% or so. But this 20% threshold, you're kind of getting down to some pretty negative sentiment. What does that really mean? Now, there's definitely some things that are probably oversold, and buyers might want to try to step in to buy some of those. I'm not saying all of them. There's some things here, we'll see in just a moment, that could still be pressured to the downside. But there's some extreme sentiment here. Now, in all those points where we were below that 20 line, we could come up with all types of things of why it should stay down. Problem is, it didn't stay down. It bounced back up, okay? So that's why it's very important to kind of be thinking bullish and bearish and bullish, because there's going to be some opportunities on both sides. Now, if we took this out, let's type in $A200R, okay? For the number of stocks above the percentage of stocks above the 200-day simple moving average. We're not seeing that extreme. Now, last year, the number of percentage of stocks above their 200-period moving average, 13%. We are nowhere near that, okay? I mean, if we talk about kind of some deep selling off points, maybe 35%, we're not there yet. So you're not really seeing that deep oversold on the 200-period moving average, but you are seeing that on the 50-period moving average. Now, let's go to this just real quick and kind of talk about some of these names. Now, I want to kind of show just two areas real quick. So if I bring up stocks, the semiconductors have been absolutely, last week they showed some signs of breaking out. And the next couple of days when Meta was sued, okay, and then it brought into question, let's say Google, etc., man, that area really got pushed down on Thursday. There's Friday, and then here's today, Monday. Now, semiconductors, remember, if we're talking about sentiment, you don't want to be seeing this chart going down, because usually if the market's going up, in areas sometimes like semiconductors tends to lead. That's kind of a black eye in the market so far. Now, if we look at also the financials, well, we talked about how the financials are like the engine of the stock market, or the transmission, if you will. Those actually hit a brand new low recently, okay? So that's not necessarily the strongest bullish signal you've ever seen in your life. And if we look at, obviously, the technology stocks, which kind of somewhat mirror the semiconductors, that actually hit a fresh new low here today, went up to the downward trending 10-period moving average, and then some investors use that as a bearish play to go bearish again, meaning they wanted the price to come back up, get closer to resistance. Why? Well, because they put a stop right above there, maybe, right? And they kind of waited for the price to be up, but the price was up in a downward trend. Someone took advantage of that, right? Now, so kind of some negative things. So we got to be brutally honest here, okay? Semiconductors really pressed down, which get dominoes into the technology sector. And then the third thing we're actually seeing is financials struggle big time. And of those four charts we talked about, right? Oil, fix, dollar, rates, struggle, okay? So we're not seeing any reprieve yet, or a bounce back in equities. The key word is yet. We're going to keep monitoring these gauges, but some of these gauges we're seeing from, let's say, sentiment, momentum, and trend, still quite bearish. Now, the one thing is, what happens is people have money, right? That money is kind of stacking up. It's kind of in their pocket or in their back pocket, and it's kind of hard to sit on a wallet where it's thickening a little bit. And some people are saying, look, I know the market's going to go down, or maybe going down, but I want to buy something. Utilities trying to get a bounce back. Basic materials getting a little bounce back right here. And you're also seeing, let's say, what else? Staples, little bit of a bounce back right here. And if you look at, let's say, the other area, which we'll mention two more, energy actually hit a brand new high here today. And the last one, but not least, the industrials. Now, the industrial is not at the horizontal support level yet, but it might be coming closer, okay? So you got to remember is when some people, they're never going to go short. And some of you have let me know that. James, I don't do bearish positions, and I don't plan to. That's fine. But you got to at least understand kind of the opposite. Why do the trends go down? And then you decide if that's something for yourself. Now, I want to kind of look at the first example for just a moment. I'm going to talk about one semiconductor stock. Let's talk about some of the bearish indicators. And then we're going to talk about a bullish example, okay? Now, if I were to ask you, what might be what now, the natural thought process is like, oh, everything's sold off, it can't go any lower. Well, there's actually some things where when you look at this, I'm going to bring up, let's say, example given like ADI. And if you look at ADI went up and it actually broke down. And what you're now going to notice is we're kind of sitting on this ledge of support, okay? Now, when we talk about bearish technical analysis, well, that would be not green moving averages. We want red ones, okay? We want red color candlesticks. We want it where the oscillator, like the MACD, is rolling down. If it's just dropping into the red, the timing on this might be a little better, right? Now, if we look at this, if we were to break support, okay, I'd probably follow to the next level, right? Well, what is that next level? Well, that next level, or path of least resistance, I'm going to kind of put the marker at 273. If I kind of did something in the middle there, it's probably 287, okay? Now, if we looked at this and said, look, we are at an area of support with a large red candle. I mean, for many bullish investors, they might say that's not really like a buy signal, right? And so the risk becomes if the sector continues to drop and some of the key stocks continue to be under pressure, well, it could drag some of these other good names down with it. That's the risk. So now what we got to ask ourselves is, well, what type, I mean, is it stock based? Is it option based? What do they got? Well, if we bring up, let's say ADI, okay, if I bring this up, ADI, go to the trade tab, type in ADI. And what I'm going to do here, ADI. And first off, the volume here, 1.1 million. This is the volume so far for the day, okay? If we look at the options, let me go to the maze real quick. If I look at the maze, those are $1.20 wide. That's 80 cents wide, okay? Now, if you look at that one right there is $1 wide. Now, we have been in this persistent situation where even if you said I like to trade options, the spreads have been wider, okay? And that really goes back to where the VIX is and how long the VIX is staying high. Now, I'm not going to show an example of going short, okay? Because I don't have, well, there's reasons for that. But what I'm going to show an example of in this case is I'm going to try to actually do, in this case, a 320, 330. Now, could there be other stocks that might be more liquid? Yeah, there are. I'll show those in just a sec. But I'm going to choose this one. But the key is we got to make sure that we're getting the middle, the mark. We like to see where the bid-ask spread is 20 cents or narrow. We don't see that. So if we got something in the middle, it's going to be a wider spread between the bid and ask. We're going to go on the call side. We're going to right-click on that bid price. Going to go sell vertical, okay? Now, if I go sell vertical, we are selling, as this is a stock trade and an option trade. Well, we don't see any stocks, okay? We got two calls. One call we're selling. If you sell a call, you think you're going to stay below that strike price. Where's the stock now? It's at 302. Where's the strike you're selling? At 320. You think the price is going to stay below there. Now, if the price goes up, this is your let's just call it the cap. The 320 is where you have an obligation to sell the shares. The 320 is where you have the right to buy the shares. You're the buyer. You're long. Now, the credit here, and this is at the mid price, is at 315. Now, when we look at these numbers and say, look, it's a $10 wide spread, you're going to see in this case the numbers are maximum profit given a vertical 315, max loss 685. Now remember, the wider the spreads are, it's hard to get in and out, okay? So now when you see spreads like this, you got more market volatility. The second thing is by having those wider spreads, kind of tries to slow the trading down where people come to their natural senses, okay? Now, notice the commission. What we're going to do is one contract. Now, that one contract, if we lose, in this paper money example, $685, we're going to go ahead and send that order. Now, this is a bearish trade. It's not making the portfolio bearish, but it's a bearish trade. Now, what I want to do, I'm not going to go into a couple of these other ones, but let me just kind of show you some other ones that have been under pressure. If we said semiconductors, it's hard not to talk about Micron, okay? And Micron just went through the support. The example we talked about last week on Thursday, is NVIDIA. We said, look, there's been multiple reasons why NVIDIA should have gone up if you looked at the, kind of the news or the releases, etc., and it didn't. We talked about could that break through the support. And just like when we talk about bearish technical indicators, which one indicator could be price, we had only gone up for just, notice that same pattern, right? If I looked at the number of days we went up, there's 3 days. There's 1 day. There's 1 day. Here's 2 days. And what you're going to kind of notice is when we talk about price, which is an indicator, and you actually look at the MACD on top, when the MACD was green, it wasn't green for very long, and it wasn't very high. And you look on the bottom here, you're going to see that the momentum, the MACD, it's even now lower than it was there. So that this, you get a break of support, you get negative price pressure, meaning when we went up, signified by green candles, it didn't go up for very long, less than 3 days. And with that, you get the moving averages where they're just red still, okay? Now remember, if you got red moving averages, you have an absence of buyers that are controlling the stock price, and you get more of those bears dominating the trend and momentum. You get more bears than bulls knocking the price down, you get the MACD momentum to push lower. And that's what we're seeing here, okay? Now, that's true. Now, BJ says MU was the saving grace up until earnings. Fair comment, okay? Now, BJ, we would tell you if that's not a fair comment, but it's a fair comment, okay? We're going to let that one slide. Now, the other one, now remember I made the comment is a lot of people think, well, yeah, all these have gone down, they can't go any lower. Well, that's not necessarily true. If you look at NXPI, that's kind of right at that area of support. If we said, where do we see the dominant support area? Recently, like 189, okay? Now let's hold this for just a sec. We did a bearish example, but let's come back over to bullish for a second, and then we're going to come back to this one, okay? Now, what are some examples of bullish? Now, we kind of talked about oil prices, right? Well, when you got oil prices, transport companies like FedEx, they might be under pressure. Now, we're going to hold that thought, right? So if they're driving around your neighborhood, town, etc., they might be actually taking more fuel, right? And that's burning through some of those profits that they were forecast to have. We'll come back to that one in just a sec. Now, they might decide instead of shipping it through 18-wheeler or FedEx or UPS, etc., that they might say, look, we have the product. We want to maybe use trains, okay? That's maybe not burning through as much fuel. Now, when you think of choo-choo trains, you're thinking maybe like CSX. You could probably think of like UNP, right? So the thing is, they have the product, but how are they going to get it to where it's the end destination? Now, if we said which one kind of looks a little bit more bullish, CSX, or UNP kind of looks a little bit more like CSX. Now, in the given marketplace, the one thing is, and we're not trying to like diminish it, right? The one thing that we're actually seeing is when you have higher volatility in the market, some of these stocks struggle to trend for longer. It's not that they don't go up. They don't just go up and stay up. They don't go up, stay up, and then trend, right? Hence choppier conditions. Now, you're going to now notice that there's earnings upcoming. Now, what I just said might influence the type of strategy that you're picking, okay? So if you don't think it could stay up, trend for longer, okay? And among other things, you might say, look, I'm going to maybe dollar cost average. I'm going to maybe buy the shares and maybe look to buy the put, which is a married put. You're trying to define the risk just in case. You could actually say in this case, maybe I want to maybe collar the position. I actually think maybe the stock might go up, but might struggle in staying up. So I think there's a little bit more neutrality of the price range. Now, where is that earnings? It's on the 22nd, okay? So in this case, what I'm going to do is let's go to the trade tab for just a moment. Let's kind of verify what's the stock volume so far. 10.8 million, okay? Now, what do you notice on the spreads? Better than before, okay? Well, this one right there is 35 cents. That one's 20 cents. That one's 20. Better. You've come over here on the put side, 15 cents, 10 cents. Wow, this is like better than what we saw before. Just narrower bid-ask spread is what I mean by that. Now, I want to kind of play the example of I want to get in, but I'm concerned about the downside. It's a fair comment, right? Now, I think a lot of times we focus on how much we think it can go up, but I think a lot of times we should maybe think about what's the risk if it goes down, okay? Now, what I'm going to do is I'm going to go to the ask price right there, ask price. So step number one is we're going to bring this up, go to the trade tab. We're going to take a bullish example. Now, when we take a bullish example, we're going to go long. Now, if the crude price is high, if it stays up for longer, some of these companies might shift how they're actually bringing the product to the end user, okay? Or whoever's going to sell it and so on. Now, I'm going to click on that ask price. Now, if we click on the ask price, that is 100 shares of stock. Where can I see that? Stock. Do we have a strike? No. Do we have an expiration? No. It's a stock position, 100 shares. Do we have to do 100? No. But if we did, in this case, 100 times 40, it's really $4,000 worth of stock. So it's not massive. Now, the one thing that's kind of interesting is when we go down to, let's say, in this case, the 37.50. Now, I want to go back and kind of answer a question. James, what if I just wanted short-term protection? Well, I just want to do this with the idea that I'm not going to hold over earnings. The earnings was on April 22nd. This expires on the 17th. So this is just short-term protection until the 17th of April. So if someone does this, they're saying, look, I'm going to try to get out. Yeah, I want to see if it goes up, how much does it go up by? And then if it goes down, I have a right to sell the shares at the strike price from now to expiration. Now, step number one is we're going to buy the underlying asset, the shares. Step two, we're going to come down to single order. First triggers SEQ. And why are you picking that 39.5? I'll tell you exactly why I'm picking the 39.5. Now, we'll look at both. When we talk about buying protection, which very few people know a whole lot about, you can know it in theory, but do you actually do it? Oh, that's a totally different conversation. Now, we like to run the math. So the math is we're paying 40, let's just say we're paying 40.10 for the shares. Where do we see that? Right there, okay? Now, that's the shares, and I'll even point to that, okay? Now, if we bought the put at, let's say, I'm going to say we buy it right here in the middle being 85 cents, you could do the math that's right at 2%, okay? So in other words, we need the stock to go up 85 cents to pay for the put, assuming a full max loss, which is, that's in dollar terms, in dollars amount. But if we said in percent, you would really need the stock to go up by about 2%. Now, the lower amount you pay for it is a lower percentage. Pay less for it. You don't have to have the stock go up as much just to break even at expiration. So I'm going to go down a little bit less. I wonder if we paid about 70 cents for it. Why did you do that, James? Well, it's an easy answer. Because we said the cap of what we're willing to buy that put for is 2%. If we bought that 39.5, that's over 2%. That's why we're going down to the 39, okay? So we're buying the shares, and at the same time, we're going to try to buy the put. Now, you can do the basic math. Now, a lot of times people will say to me, I want to be a millionaire, but I'm not good at math. How do you think you're going to be a millionaire? Okay, it doesn't make any sense, okay? I want to have a ton of money, but I can't do math. It just blows my mind, okay? So here's the deal. Let's just say 40-10. Let's stick with that. It moved a little bit, but we can do basic math, okay? So if we buy those shares at 40-10, we have a right to sell those shares at 39. So what's the risk on the shares? This is not a trick question. What's the risk on the shares? No, I mean, just doing basic math, which you could probably get a fifth grader to do it, right? It's $1.10, okay? So there it is, $1.10, not tricking you, okay? We buy the shares here, and we have a right to sell the shares at 39. The risk per share defined, not a maybe, not a theoretical, not a depends, is $1.10. But you got to remember, the right's not free. So what did you pay for that right to sell the shares at 39? The answer is 75 cents. Now, so this right here is the stock. That's the risk on the stock, okay? And the reason why you got it to be like that is you're paying for the put. So we need to add that. So everyone together type in the chat. Don't say you're not good at math, okay? I mean, for crying out loud, we want to move the account. We got to be thinking about risk, okay? To quantify risk, we got to do some basic math here, okay? Now, if we said, well, what's the defined risk? The answer is it's $1.85. Now, obviously, you like to kind of figure out the dollar amount so you can position size for it. But here in this case, we're risking $1.85. That's the in dollar amount. So we also kind of like to think about this. Well, what percentage of what I'm paying for the stock are we potentially losing? Well, we already said, what's the percentage? We said $1.85. To figure out the percentage, you would just divide it in what you're buying the stock for. Can anyone tell me what that is? Okay. Now, we didn't care if the market was going up, sideways, or down. If we actually said, well, geez, this position is 5, it looks like it's about 5%, okay, which it looks like it is, and I'm double checking the numbers myself. 185 divided by 4010, it's 4.6%. Now, that's pretty interesting. I mean, in any given market, to really take a bullish position, you probably have to risk 3 to 5% just to see if the stock is going to bounce. But in a market where the VIX is, let's say, 30, to have a defined risk for 18 days, 4.6% or $1.85, some investors might consider that, okay? Now, the stock goes up, do you have a cap? No. What do you have? You have a right to sell, and we call that a floor, okay? Now, are there any questions with that? All right, so here we go. So I'm going to go back to this. So how do you buy the put? Well, remember, all we did is we go first triggers SEQ, click on that, and then you come to the put you want to buy right there. Now, could we move down the price? Yes. And now what you're going to see in this case, we're going to move it down to about 70 cents. Now, I got to tell you a super quick 30-second. On Friday afternoon, I helped a neighbor cut down a tree. It was just me. Big 20-pound chainsaw, 30-foot tree. And as I had a little accident, okay, it reminded me of trading, okay, just kind of smashed up arm. I literally did the notch in the tree, which I thought it was like, fine. I cut the back, thinking it was just going to timber over, but I took the chainsaw right through where you're supposed to leave about 2-inch gap so it tilts over. I went too fast, and that chain broke through the tree. Well, it pivoted back because my notch on that tree was tilted back towards me. I look up and see a big tree coming back towards JB, and I thought to myself, you did the order too fast. Now, I'm just grateful to be not below support, okay? If I didn't do high school ballroom dancing in high school and have such quick feet and be able to kind of forearm over that tree, holding that moving saw, okay, definitely, guilty. Now, I bring that up to here. This is where you want to read out loud. So if you're talking out loud to yourself, that's fine, okay? So in this case, 100 shares of stock. Okay, that's fine. That's what we talked about. Now, number 2, We're buying the 17 April 39 put, okay? And for 70 cents, we're going to check that price. And it's moved a little bit on us as we talked about that. So I'll move it back to what we had before, which is about 75 cents. If we said we're buying the shares and buying the put at the same time, that's a married put, okay? Confirm and send. Now, there's not a commission to buy the shares. Now, the reason why I bring up the example of the chainsaw is the little analogy of measure twice, cut once, okay? That's why I bring that up right here, okay? Measure twice, verify, which we did, and we're going to go ahead and send that order, okay? Now, yeah, here's the thing. I mean, I saw that tree literally come back, and I kind of forearmed that tree out of the way. I was like, I got to pick up Amber tonight at the airport. So this can't be how it ends. So anyway, yeah, I call that tree the Widowmaker at the end of that. I will never cut. I've cut so many trees down. I got overconfident. Okay. Yeah. Anyway, lesson learned. Now I want to go back to just real quick. One of the examples that we actually brought up from before. Now I want to go back to one stock we have not made mention of, okay? Netflix. Now, Netflix, what did they do last week? What did they announce? What did they announce? Well, they didn't announce earnings, but they announced that they were raising the what? Yeah, they announced that they were raising the prices on all of their plans, okay? Now, if we take a look at this, the stock went up a little bit initially and it's kind of pulled back. Now, I'm saying this because some people, they're not going to do bearish trades. Now, if we look at this technically, we're kind of right near an area of support. You can see on the bottom there that MACD trying to rotate a little bit back to the upside. Now, what I'm going to do on this is I'm going to set a bullish trade on this based upon the price getting above the lowest, most recent red candle. Now, so number one, where is that high of the lowest, most recent red candle? Well, the lowest, most recent red candle was Friday, and the high of that day is 95.54. So an investor might say, well, I'm going to take a bullish position if we get at or above that high. Well, at or above that high would be, let's say, if we added a quarter to that, example given, like a filter, price filter, that'd be, let's say, 95.79. Okay, now, that's if someone said, I want to trade a stock. If someone said, look, James, I kind of want to get in a little bit closer to support, which they're thinking that it might turn into a potential higher low. Now, this is kind of funny with like subscriptions. One time I cut my son's TV subscription and I thought he was going to cry to his mom. Okay. My son's 28 years old. Anyway, people get really sentimental on when you cut their shows. Okay. I don't know if you've ever done that. I'm not saying to do that. It's not a recommendation. But I thought my son was going to start crying. Okay. Now, what I'm going to do is, so we talked about if someone's going to buy a stock, they might say, I'm going to do a buy stop order, buy stop limit order. And it's really based upon where that high is. But if someone says, look, I'm kind of counting on that Netflix, you know, they raise those prices, they might give an updated forward estimate on what those earnings might be in the future, quarter, year, and so on. Now, what I'm going to do is going to go back to the trade tab. Now, there are some investors that say, look, I like to buy stocks at a potential discount, and I want to choose what that discount is from where the stock is now. Where's the stock now? $93. Well, now when we actually take a look at it, when you say discount, what type of discount are we talking about? Have you ever had your spouse come home and said, man, I got these on sale? And you're like, well, yeah, you're right. You saved 20%, but you spent 80, okay? Now, my wife says, hey, look, you take all the fun out of it, okay? And someone has to, okay? Someone has to be the other side. Now, if we take a look at this, spreads, what do you notice? 10 cents, 10 cents, 10, a little bit tighter, okay? So you got 4 cents, 4 cents, 3 cents. Better liquidity, Okay, at least right now. Liquidity is, we're talking about right now, 17 million shares currently. Now, when we look at the strike prices, we're talking about the Aprils. Those are still pretty liquid. Now, if you said, well, James, I was kind of thinking about giving it a little bit more time, do we still see that type of liquidity? 10 cents, 10, 10, 10, 5 cents, 5 cents. Now, when you look at the ROR, that's really like taking a look at the option premium you're receiving divided into the current stock price. So you could kind of think of that like option yield. It's like stock dividend yield is the current dividend for the 4 quarters divided by the current stock price. Stock dividend yield, okay? Well, here we're not taking a look at 4 premiums. We're just looking at what is the premium divided by the stock price. Same idea. Now, if we said, well, James, in this market, I don't want to go out to May. I don't know what's going to happen on Friday, okay? Which, by the way, the Friday's closed. So I don't know what's going to happen on Thursday. Well, let's say we decide in this case that we're going to go down and maybe try to sell a lower strike. Well, if we sell, let's say, a lower strike, that has a delta of, let's say, 29. So a lower delta, meaning a lesser chance, not no chance, lesser chance of the stock to close below that strike price. Now, if we want to sell something, we're going to go to the bid column. Click on that 212. Now, if we click on that 212, it brings up a line in red. We're selling something. Remember, I don't want to show you my arm again. Okay, measure twice, cut one time. Okay, sell -1 for one contract. 17 April, 88, 212. Now, could you move that maybe a penny? Oh, we'll try. And there it is. Now, remember, that premium, we don't make it immediately, but it does go into the cash balance. And you're going to see that now we have an obligation. What's the obligation? Well, the obligation is to buy the shares at the 88. We collect the premium, and we actually get a break-even at expiration of 85.87. So that stock could go down about $8 from the current price level down to there. The 213 is the credit, max gain. That 85.87 is assuming the stock went to 0. Okay, so that's why it's showing that. Now, what I'm going to do in this case is also notice the commission as well. 65 cents a contract. So we're going to actually send that order. I'll leave that right there if you have questions on that. But I got to wrap this up. So we did 3 trades here today. I want you to keep an eye on these semiconductors. I want you to keep an eye on the tech stocks. I want you to keep an eye on the financials. If those areas keep going down along with the 4 other main sentiment gauges we've been talking about for about 3 to 4 weeks, you need to keep an eye on that. That's going to probably tell you if the market's going to bounce back. Also keep an eye on that S&P A50R, the sentiment gauge for the percent of stocks above the S&P 500, the 50-period simple moving average. Keep an eye on that. That's kind of getting some extreme oversold readings. Now, I'm out of my time here today. Thanks, Barb Armstrong, for answering those questions in chat, and thanks to all of you. Stay tuned for Cameron May coming up next. Don't forget to subscribe. You can do so for free. Click on that box right on the YouTube page. Remember, with what we discussed, we did a bearish example and 2 bullish examples. And also remember that all investing involves risk. We talked about kind of using some bearish technical indicators, looking at negative momentum, and also using the MACD. With that said, stay tuned for our next webcast coming up next. Thanks so much. Take care. Bye-bye.